Thank you for having me, and thank you for a great conference so far. This is joint work with Guillermo Ordonez from University of Pennsylvania. So stock markets play two critical roles in economies. Firstly, these traders spend money, resources to learn about the future profitability of different firms, and the stock prices that emerge from their interactions can give us a window to their collective wisdom. So whoever is involved in the capital allocation decisions in the economy could look at the prices and get a sense of which firms the traders think are going to perform better in the future. A second role stock markets play is they provide liquidity. Traders who are in need of quick cash can sell their stocks and then achieve some quick cash. And you would think that the extent to which traders rely on stock markets for accessing quick cash would depend on how much liquidity is available in the banking sector, in the funding markets. In other words, how much these traders rely on market liquidity depends on how much funding liquidity is there. So we're going to ask a few questions that are in the intersection of these two roles of the stock markets. For example, does the use of stocks for liquidity enhance or weaken their role in being able to provide information? How does the liquidity distress originating in the banking sector in the aggregate affect price informativeness? Like, how much can you learn about what the traders think by looking at a cross-section of prices? And lastly, how would the information content of stock prices change with the business cycles? As you might imagine, booms are generally periods where liquidity is abundant. So we're going to do three things in this paper. First, we're going to start by building a model of stock trading and information. In this model, there's going to be endogenous information acquisition and endogenous noise. And real sector will learn from the asset prices. Hence, capital allocation will respond to the asset prices. Secondly, we're going to structurally estimate price informativeness in several countries. We're going to show that it exhibits cyclicality when you look across a panel of countries. And we're going to be able to decompose it into several contributing factors. Lastly, we're going to calibrate this model to the US economy. We're going to show that what you could think as liquidity shocks tend to coincide with your classical RBC technology shocks. And when they come together, the recession is twice as costly. And recessions can be cleansing or sullying. In particular, recessions without liquidity distress tend to lead to better allocation of resources during this recession, while recessions with liquidity distress lead to worse allocation of resources. So I'm going to give you a bird's eye view of what we're doing. This is not the real model, so don't pay too much attention to it. In a classical RBC with heterogeneous firms, you would have this basic structure, and one of the equations would essentially tell you that the marginal product of capital should equalize across firms. Joel did a good job explaining this yesterday, but it's been 12 hours, so I'm assuming you forgot. So what we're doing here is, what if whoever is involved in this capital allocation decision didn't know the idiosyncratic productivity of the firm? This could be the firm itself, or this could be whoever is lending to the firm, and so on and so forth. Didn't know the ZI, therefore couldn't use the true ZI in this capital allocation problem, but instead had to rely on an expectation that relies on the prices available in the economy. If this was the case, the extent to which this posterior expectation about ZI differs from the true ZI, there would be a misallocation caused by this information friction. So most of our modeling efforts in this paper will go to formulating this expectation operator, and we're going to keep the rest of the model as simple as possible. So let me give you a broad overview of what the model is going to look like. So you probably know about this Grossman-Stiglitz type asset markets. This Grossman-Stiglitz structure has the structure that if the traders have Cara utility functions, if the unknown quantities are normally distributed and additive, then you get something very nice, linear pricing functions. This makes the theory tractable and then makes inference much more easy. We're going to start from this Grossman-Stiglitz structure. We're going to keep endogenous information acquisition, but we're going to differ in one front. In the classical model, assets differ with respect to their fundamental payoffs. There are traders who care about this fundamental payoff, and there are some noise traders. Noise traders are submitting some random demand for these assets, and you need them. In their absence, prices would be perfectly revealing, and there wouldn't be incentives to acquire information in the first place. What we're going to do is we're going to say, how about if the assets differ in two dimensions, both in terms of payoff, but also in terms of what we're going to call their liquidity. And liquidity will mean if I wanted to sell this stock in a short amount of time, how much losses I would have to incur because I have to sell it immediately. So our concept of liquidity could both be about like finding a counterpart, but also about, for example, how volatile the price is. When you're trying to sell a very volatile stock, you may end up having to sell it in a low point, and then that could be something bad as well. So what if these assets differed on both of these dimensions? And what if there was heterogeneous rational traders? Some of these traders would prioritize the payoff, and others would prioritize liquidity. If this was the case, you wouldn't need noise traders. The trading activity of one type of agent would create noise for the other type of the agent. So by looking at the price, you couldn't tell if the price is high because some people think that this stock is going to perform well in terms of fundamentals, or because this stock is expected to be liquid. And if you have worked with, and this will be a shortcut for us to introduce the concept of liquidity in the trader's decision making. And if you have worked with these models before, this paranormal linear structure is beautiful, but it's also very fragile. So if you try to change the assumptions a little bit, you can quickly lose the linearity of this pricing function. So one of our contributions will be to give you a way in which you can incorporate this Grossman-Stiglitz structure into a nonlinear macroeconomic model, but still preserve the linearity of the pricing function. In the macro side of things, there's going to be two dimensions of misallocation, static across firms, and dynamic misallocation, because you may not want to invest as much if you know that the productivity is going to be low next period because of static misallocation. This structure is going to give us increased information acquisition and increased misallocation during liquidity distress. And it's going to give us a pricing equation that we can easily take to data. So let's look at the details of the model a little bit. We have three agents: traders, your regular macro households, and a mutual fund, which is essentially a modeling construct that gets the capital from households and gives it to the firms. Of the traders, there's going to be two types, as I mentioned. Some fraction is going to be day traders. Some fraction is going to be, we're going to call them night traders. These are just names. There's no night and day in the model itself. You should think of day traders as those who may have to sell early. Therefore, they care about the liquidity of the stock that they are purchasing. Night traders are going to hold the stock for a long time, so they don't care about liquidity. Gamma denotes the fraction of day trader. It's going to be an aggregate state of the economy. It's going to follow a Markov process. Gamma is one of the few Greek letters that I'll ask you to keep in mind. So some periods, there's going to be a high gamma, meaning there's a lot of traders who care about liquidity. And this is going to be our way of modeling some liquidity distress in the banking sector. If there is liquidity concerns in the economy as a whole, there's going to be a larger fraction of traders who care about it. In terms of the technology, this is what the profit of a firm is going to look like. Firms are going to have two types of capital. KI bar, we're going to call this installed capital. Firm cannot choose it or change it. It's just there. And there's going to be a KI, which is going to be a fully flexible capital, which is rented from scratch every single period from the markets. And there's going to be some adjustment cost to add some curvature on the production function. And it's going to be clear why I have this weird-looking profit function in a second. There are three assets in this economy. Let's start with capital. Consumers will own capital, and this is somehow going to reach the firms. And the mutual fund is going to be the intermediary who makes this allocation of capital towards the firms. And we're going to model the mutual fund in a very particular way. When the mutual fund is interacting with the consumers, it's going to act as if it's in a competitive setting. So all the surplus in that transaction will accrue to the consumers. On the other hand, when the mutual fund is dealing with the firms, it's going to act as a price discriminating monopoly. It'll essentially give a take it or leave it offer to each firm of a capital amount and an interest rate, which essentially suctions off all the profits that are associated with this rented capital from the firm. Why is this useful? When this happens, it will be the case that firms' profits are just going to boil down to ZIN times KI bar. Anything related to KI is already removed from the firm via the mutual fund. This will ensure that beliefs about what the productivity of the firm is going to influence how much capital is allocated to this firm. Yet, how much capital is allocated to this firm is not going to influence how much profits the firm makes. So from the owner's perspective, from the trader's perspective, how much capital is allocated is irrelevant. If we allowed two-sided interaction, if productivity could influence capital allocation and vice versa, we could create a feedback loop. This would quickly lead to price being not linear anymore. So we cut that feedback loop in step one. We don't allow the capital allocated to influence the trader's returns. That way you can preserve the linearity of the pricing function. And you can partly see that on how the shares work. One share of this company is going to be ownership of 1 unit of installed capital. So if you're a night trader, your payoff from owning a stock is ZIN. That's your period payoff, plus the resale value of the stock. But if you're a day trader, there's going to be an additional term, ZID. This is going to be a reduced form way of introducing some liquidity concern. If you're a day trader, you know you might have to sell this stock, and there's a stock-specific premium you have to pay because you're trying to sell early. You can think of there's like a broker who's willing to buy the stock from you early but charges you a fee based on how volatile the stock is and how much risk the broker has to face. In our revision, we're working on a way of kind of micro-founding the CID. It's going to look nicer later. And there's going to be an international bond that acts as a currency, so I'm not going to talk too much about it. To summarize, gamma represents the fraction of day traders, the aggregate state. ZIN represents the productivity of the firm, and ZID is something that only these day traders care about, has no bearing on the real things in the economy, at least not directly. Both ZIN and ZID are going to have these structures. There's an aggregate productivity, but beyond that, both for ZIN and ZID, there's a part that you can learn, thetas, and there's a part that you cannot learn, even if you were to go through it. In order to learn these thetas, you have to pay a particular cost, and the cost you pay depends on how many others have acquired information about this. This is just to ensure there is no multiplicity due to complementarities in information acquisition. Lambda is going to denote the equilibrium fraction of night or day traders that have acquired information. I'm going to show you some of the optimality conditions to give you some intuition about how the model works. We have 4 different types of agents, 4 different types of traders in this economy. Day and night traders, informed versus uninformed. Each of them have this simple Kara demand functions with excess return divided by variance. Day traders' only difference is they have the ZID that the night traders don't have. And the informed guys differ because they can condition on the true theta instead of having to rely on the prices, which is an imperfect signal of the true thetas. Market clearing is straightforward, and the information acquisition is in an interior equilibrium. The traders will be indifferent between acquiring information versus not, and that is given by balancing the cost of acquiring information with the reduction in variance you can achieve by acquiring information instead of relying on the prices. This is the final part of the model. Household side, there's nothing really interesting. Mutual fund does an allocation that is constraint efficient. So given what the mutual fund knows, the mutual fund does the best allocation possible. This is the equilibrium definition. The only part that you really need to pay attention to is number 1. We're going to be looking at a linear rational expectations equilibrium, linear in the sense that there's going to be a pricing function that is linear in the 2 unknowns, theta ID and theta IN. One is about liquidity, the other one is about the firm's fundamental productivity. And keep in mind that we have 2 aggregate states in this economy. Maybe I didn't clarify it. Capital Z is the aggregate productivity, which is going to fluctuate over time, and gamma is the fraction of day traders. All right, we're going to define price informativeness in this setting as such. It is going to be the reduction in variance you achieve by looking at the prices divided by the reduction in variance you could achieve if you acquired information directly. This is naturally between 0 and 1. If looking at the price helps you almost as much as acquiring information, this will be close to 1. This is a very informative economy. If, on the other hand, the reduction in variance achieved by looking at the price is minuscule relative to what you would have achieved by acquiring information, then price informativeness is close to 0. And this kind of gives us our concept of price informativeness. This is not about the stock's price's ability to predict future returns. This is about how well the stock prices reflect what the traders knew at the time. So maybe the stocks are terrible at predicting the future returns, but they were great at reflecting what the traders knew, which was little. We will still say this was a high price informativeness period. Stock markets did the best they could. Going forward, we're going to assume that these parameters are firm invariant. So we're going to say that firms in the cross-section are drawing from the same distribution. Their draws are different, but they're drawing from the same distribution. Essentially, we're going to restrict the cross-sectional heterogeneity so that we can use cross-sectional variance to estimate what distributions are leading to them. Under these assumptions, fraction of informed investors, pricing functions, and the price informativeness measures will be economy-wide. It's going to be the same across firms. And it's going to boil down to this simple-looking formula, where it only depends on the variance of the signals and phi's. What were those phi's? Just a quick reminder. Those phi's are the linear loadings in the pricing function. It looks simple, but I should point out that these phi's are equilibrium objects, so they have complicated expressions for the parameters. But what if I could observe these 4 objects? Then I wouldn't need to solve the entire model to be able to compute this price informativeness measure. So going forward, our goal will be trying to estimate these 4 objects from the data and then be able to measure price informativeness without having to solve the entire model. We're going to solve the model later for other purposes, but at least not for this. And I'm going to give you 2 quick formal results from the paper. I'm going to mention them quickly. It turns out this ratio of these pricing parameters is essentially depend on the amount of informed trading done by day traders relative to the amount of informed trading done by night traders. So if there are more day traders, or if they are more aggressive in acquiring information, or they are more aggressively trading on the information they have, then price informativeness is going to be smaller. The second one is, it turns out that there is a monotonic relationship between this arbitrary pricing informativeness measure that we have put there and the quality of capital allocation in the economy. So when the price informativeness is high, you should expect the capital to be better allocated. Let's move on to the empirics. We're going to estimate the model in 2 steps. We're going to start by estimating the pricing function for each country year pair. What would that look like? Well, price is a linear function of these objects. I'm going to essentially come up with measures of theta ID and theta IN, run an OLS. The OLS is going to give me the phi's. So I'm going to have everything I need once I do that to be able to compute the price informativeness. If I said this is what theta day is, this is what theta n is in the model, their variances is going to give me the sigma squares, their sample variances, and the OLS regression coefficients are going to give me the phi's. Then I'm going to internally calibrate the remaining parameters of the model. And in this, I'm going to recover the series of gamma, the fraction of day traders, as an unobserved state. So we're going to estimate that unobserved state in this calibration procedure. For this, we're going to use 3 sources of data. World Scope is going to give us monthly stock prices and yearly fundamentals, importantly for several countries. In the end, we're trying to learn about cycles. If you stick to US, you have, 4 recessions, and then you have 4 observations to work with. This is going to give us a lot of recessions across several countries, so we can actually test these cyclicalities and whatnot. IBES, we're going to use it for analyst forecasts of earnings. This is going to be our measure of theta n's, what the traders thought how productive these firms would be in the future. And we're going to use several measures of aggregate liquidity in the economy. So, as I told you, for computing price informativeness, I need these 4 objects. What I'm going to do essentially is I'm going to map PI to the current price. Obviously, in the model, I killed a lot of heterogeneity across companies. So instead of trying to make the model look like data, we're going to try to make the data look like the model by residualizing the prices based on many sources of heterogeneity that are not taken into account. But think of your PI as your price that you observe in the stock markets. We're going to map ZIN, the realized productivity of the firms, as the payoff in the upcoming period. This is going to be the earnings per share that is realized in the next period. But obviously, we don't need ZIN. Price is a function of theta IN, what the agents knew at the time. So I'm going to use analyst forecasts to get a sense of what theta IN was. I'm going to treat that as what the traders knew after acquiring information. I'm going to think of ZID as the short-run fall in payoff because you have to sell early. And I'm going to map that to the volatility of the price in the upcoming period. Again, I don't need ZIN. I want to know what the traders thought the volatility would be at the time. But I'm not going to have, unfortunately, a forecast of these volatilities, so I'm going to have to rely on the volatility in the previous period as a proxy for what the traders thought would happen. Ignore the last bullet point. It wasn't supposed to be there. Yeah. So this is what the price informativeness estimate looks like for the US. A few things. In good times, it is almost close to 1. Prices are very well correlated with the earnings forecasts, not so much with the liquidity. But in bad times, their correlation with the liquidity of the stocks spikes up. You see a big decline in 2020, 2008, an extended decline around the savings and loan crisis in the US. And we do this obviously for several countries. I don't have time to show you all of them. But when you look at a panel, you would quickly confirm what the US is telling you. The price informativeness is quite cyclical. In periods of high growth, or when the periods of high growth of the public sectors of these countries, price informativeness is high. But it is also high when the liquidity is abundant. These two things are quite correlated. So in the remaining part of the model, we're going to try to disentangle these two pieces a little bit. And I'm not going to go into detail about the internal calibration of the model. I would say it's quite interesting. It's not straightforward in terms of revealing the hidden state. But essentially, we are going to try to make sure that the model can replicate the dynamics of the pricing function that we observe in the data. That's the broad essence of it. But I'm happy to discuss the details of it if you have time later on. OK, counterfactuals. So this is the main result of the paper. What we're going to do is we're going to simulate 2 counterfactual recession periods. I want you to start by looking at the solid line. The solid line, there are 2 things happening. Aggregate productivity declines, and gamma spikes up. There is suddenly a larger fraction of day traders. We're going to think of this as sudden liquidity distress in the funding sector. What would happen if these 2 things coincided? There would be an increase in information acquisition, both from the day traders and night traders. In total, information acquisition would increase by about 15%. Even though this happens, price informativeness would decline, because suddenly there are more day traders. They are trading heavily on the liquidity of the stocks, so it becomes more difficult to infer the payoff, the fundamental payoff the real sector cares about when you look at the price. So the price informativeness declines by about 10%. This leads to a worse allocation of capital on top of this decline on this capital Z. You would see a big output decline and a big decline in investment. What does the dotted line tell us? It tells us, what if this recession happened without the liquidity distress, without a spike in gamma? There would be still an increase in information acquisition, something I didn't mention, an increase in capital Z. We also take into account variances and uncertainties could be increasing. And this is indeed the case in data. Because there is a higher uncertainty in this recession period, there is somewhat of an increase in information acquisition by both types of traders. Aggregate information acquisition goes up, but not nearly as much. Price informativeness, if anything, increases, because there is no excessive day trader activity, and the night traders are reacting more aggressively in terms of acquiring information. So allocation of resources actually improves. You still have a recession because of the big capital Z decline, but it is not nearly as bad as it was when there was liquidity distress as well. The recession's initial spike is half as big as the full recession. This is something that we can actually test in the data. Now we're going back to our panel regression. You see several columns. In each column, we're using a different measure of aggregate liquidity. Some of these are positive measures. Some of these are negative measures. So the signs are different, but they all tell you the same story. And what it tells you is this. Once you condition on the GDP growth, once you condition on the productivity shock, when liquidity is higher, price informativeness is higher. And for most specifications, there's a significant relationship between the two. On the other hand, when you fix liquidity and look at what happens when GDP growth is higher, the price informativeness is actually lower. So in general, recessions without liquidity distress, as predicted by our model, are not that bad in terms of improving the allocation of capital. Liquidity distress is the one that is causing the decline in the quality of capital allocation. We do a couple more counterfactual exercises that complement what we've been doing before. The first column is the baseline. What happened in the plain vanilla big recession? We see that the information acquisition has improved, price informativeness declined by 10%, output declined by 15% on impact, investment declined by 18% on impact. In the second column, we do a counterfactual exercise where we say, what if we didn't allow the traders to react by changing their information acquisition behavior? It says things would have been much worse. The recession would be almost twice as costly. So the endogenous information acquisition, as a response to these two shocks, is actually undoing some of the damage that would have been there, not allowing the price informativeness to dip. In columns 3 and 4, we're doing an additional exercise. I haven't shown you these parameters. But this essentially says, what if the cost of acquiring information for night traders was half as much as it used to be? And this is what if the cost of acquiring information for day traders was half as much as it used to be? And what this tells you is, if you make it easier for night traders to acquire information, if you make fundamental information easier to access, this could be, for example, making SEC filings more detailed so that people can learn, so on and so forth, the recessions would be much easier to bear. It would be much less damaging. On the other hand, if you made it easier to access information about the liquidity of these stocks, maybe, I don't know, requiring the exchanges to share more information about the types of trades going on and so on and so forth, actually the recessions would be worse. When you make it easier for day traders to access information, you're essentially encouraging them to trade more on what they know, which leads to a lower price informativeness and which just amplifies the initial impact of the recession. So to conclude, what we've done in this paper is we built a model of asset trading with endogenous noise in it. We integrated this into an RBC setting where we could simultaneously capture the dynamics of information allocation, acquisition, and misallocation that we observe in real economies. We structurally estimated the stock price informativeness and showed that it declines during recessions that are coming with liquidity distress. A calibration to the US shows that the recessions are not all equal. Recessions without financial crises actually make prices more informative, improve the allocation of capital, and buffers output losses. On the other hand, recessions with financial distress make prices less informative, reduces the price informativeness, reduces the quality of allocation. And this is, we consider this valuable because when you look at the data, there is somewhat of a disagreement with regards to whether recessions are actually cleansing, whether the quality of capital allocation improves or deteriorates. And you see people using different episodes in the past coming up with estimates of, or evidence consistent with improved capital allocation and deteriorated capital allocation. Our model is able to generate both and essentially says you have to take into account what happens with regards to liquidity in these recessions. That's all. Thank you.